Hi folks, welcome to Link Business Sales. Today we're talking vendor finance. What is it? And what are the positives and negatives around this business sales strategy? Vendor finance is very simple. Like any regular sale, both parties must reach an agreed price and terms of the sale. However, the vendor will agree to take payment for the business over a time frame and after settlement of the business, exactly like a loan would work with the bank. For example, the agreed price of the business is $1 million and the purchaser would pay $500,000 on settlement and $500,000 would be paid off in time. So, what are the benefits and considerations for the seller? And is this an option worth pursuing? Let's go through the most obvious pros and cons. Firstly, this strategy should be considered only if the seller is in a position personally to do so. The pros: increased sale price. Often, the buyer will end up paying more for the business once interest is factored in. A faster sales process. More buyers will be able to afford the business that couldn't before. This means a bigger buyer pool and better leverage for the seller in terms of speed and the total price of the business. This can potentially add thousands and possibly hundreds of thousands of dollars to the total price. Now, I'm not fully endorsing this strategy. There are some negatives. Firstly, you receive a lower payment up front. This could restrict you from pursuing other options after the sale. The purchaser defaults on the finance. What will you be able to recover if this happens? There are two best practice strategies that are absolute musts for a vendor to stick to, and don't let any broker tell you otherwise. Vendor finance should only be agreed upon if the business can sustain the repayments and a reasonable wage to the purchaser in its current performance state. Otherwise, how can it work? Secondly, the vendor must have a security charge over the assets of the business and a personal guarantee from the purchaser. What does this mean? Well, basically, this means that the vendor can take repossession of the business and have an interest over the purchaser's personally owned assets if they default. So is this option for you? Well, I've used this method several times. I'm pleased to say that it has worked brilliantly for both parties. In fact, the businesses may even still be on the market if we didn't adopt this strategy. But it will come down to your personal preference. Good luck and happy selling. Thanks very much for watching. Bye.